My name is Mansoor Suhail. You may call me Manny for short. I'm an accountant operating out of Scarborough, Ontario, Canada. My specialization is tax for Canada and USA. This presentation is for educational purposes only, and my topic of today's presentation is Canadian Tax Treaties. Tax treaties play a very big role in international trade. Anybody who wishes to go into international trade must consider implications of the tax treaties. Canada has tax treaties with almost 90 countries in the world. All Canadian treaties are based on the OECD or the UN model. OECD is Organization for Economic Cooperation and Development, and UN is United Nations. Main objective of the treaties is to prevent double taxation or tax evasion. OECD is an international organization and Canada has been its member since it was formed. The original OECD model was published in 1963, revised in 1977, and again in 1992. Many non-member countries also follow this model when it comes to treaty negotiation. OECD model generally favors residence taxation. According to this model, it requires source country of income to give up taxes on income that is earned by residents of other treaty country. The UN model was first published in 1980. It was revised in 2001. It usually follows the OECD model. Canada's tax treaties contain elements of the OECD and UN models. Canada has the largest treaty network in the world. Canada has a treaty with each of the OECD member countries and major trading partners that are non-OECD countries, such as China, India, and Brazil. Canada has also entered into treaty with Kuwait, the United Arab Emirates, and Oman. These countries do not have an income tax system which can be compared with Canada. Canada has also gone into tax treaties with low tax jurisdiction countries that include Barbados, Cyprus, Ireland, Luxembourg, and the Netherlands. In Canada, Parliament has to pass an implementation statute so that a signed treaty becomes a law. In general, treaty prevails over domestic law. Taxpayers depend on treaties for getting the tax benefits. A treaty is incorporated in a domestic law so that a taxpayer can rely on it. There is no binding of provinces of Canada in tax treaties. Article 4 of the OECD model defines the term residence, and Article 5 of the OECD model defines the term parliament, permanent establishment. Under Canadian law, residence of a corporation is determined by either the place of incorporation or place of central management and control. Tax treaties help us allocate tax jurisdiction. On the basis of OECD model, jurisdiction is determined based on primary source or territorial taxation of active income, passive income, and limited source taxation, such as Article 10 dividends and Article 11 on interest. According to Article 7 of the OECD model, business profits of an enterprise resident in one country are only taxable in another country if it operates as permanent establishment in the other country. There are three special types of business profits that do not fall under permanent establishment. Number one, real estate income. Number two, international shipping and air transportation. And number three, income earned by artists and athletes. Article 90 of the OECD model deals with associated enterprises. Under this provision, an enterprise will carry business in two or more treaty countries in the form of a subsidiary. Director's fee received by a person from a company that is resident in another country may be taxed in the country it is resident of. Article 17 of the OECD model covers income earned by athletes and artists. Passive income is usually taxed in the residence country. Capital gains are taxed as active income under Income Tax Act. Canadian treaties limit source taxation so that capital gains are taxable only in the country of residence. Article 21 of the OECD model deals with other income like alimony and social security payments. Canadian treaties usually follow the UN model for taxation of other income. Article 4 of the OECD model provides tiebreaker rules for determining the residence to one country based on location of permanent house and social or economical ties. Canadian tax treaties adopt a method of foreign tax credit. If the taxpayer is taxed first by the source country and then by the country of residence, tax treaties limit source country taxation and require the residence country to provide relief from double taxation. If two countries claim to be source of an income, tax treaties can help reduction of taxes using sourcing rules. Canadian tax treaties have a non-discrimination provision which prohibits discrimination based on nationality or discrimination against non-residents operating a business in Canada. Canada has included an exchange of information provision in its double taxation treaties. All Canadian treaties generally follow Article 26 of the OECD model. According to this provision, tax authorities can exchange information of the taxpayer with each other. Tax treaties have certain limitations. For example, treaties can only deal with double taxation between two countries. In case of three countries, like a resident in country X earns income in country Z through a permanent establishment in country Y, it is a difficult situation and cannot be handled with tax treaties. If all three countries follow OECD model and have a treaty with each other, the possibility is that this situation may be addressed with three separate treaties. There also exists a mismatch in domestic laws of different countries. This can result in double taxation. For example, a US limited liability company is treated as a corporation in Canada, but it is a flow-through entity in the United States. These kind of mismatches make it very challenging to interpret tax treaties. In the end, the ultimate purpose of tax treaties is to accelerate international trade and investment and eliminate double taxation. These are few of the references I searched for this article. And once again, this is my information. My name is Mansoor Suhail. I'm an accountant operating out of Scarborough, Ontario, Canada. My expertise are tax for Canada and USA. My telephone number is 416-283-8774. Thank you very much for listening.